We often talk about the future of clean energy, advanced defense, space exploration, but how often do we really stop and think about the invisible foundation?
Right, the super precise components that literally power these advancements.
Exactly. It's not just about the big ideas, it's about the tangible, micro-engineered parts that, well, make them actually happen.
Mm-hmm.
Welcome to a deep dive into MTAR Technologies Ltd. They're a company quietly, at the forefront of manufacturing these incredibly critical, highly differentiated engineered products.
A key player for sure, even if not always a household name.
Absolutely. So our mission today is to cut through their latest Q1 FY26 financial results, their investor presentations, recent press releases, and board meeting outcomes.
Lots to unpack there.
Definitely. We're going to uncover the most important insights, maybe some surprising facts, and help you understand what this company's performance truly means for sectors vital to our global future.
And there's a key question, isn't there?
There is. MTAR just reported some, frankly, jaw-dropping profit growth, but their actual revenue dipped quarter over quarter. What's that paradox about?
Yeah, what's the story behind those numbers?
Let's dive in and find out. So let's start with those headline numbers. First quarter of fiscal year 2026, ending June 30, 2025. How did MTAR actually perform financially?
Well, looking at their unaudited consolidated results, the year-over-year picture is pretty compelling. Revenue from operations was up 22.1% compared to Q1 last year.
Okay, solid growth.
Yeah, it went from about Rs 128.3 crore to Rs 156.6 crore. But here's where it gets really remarkable. The profitability metrics just surged.
How much are we talking?
EBITDA jumped, get this, 70.9% year-over-year to Rs 28.4 crore.
Wow.
Profit before tax, PBT, absolutely soared by 138.7%, hitting Rs 14.8 crore.
Okay, that's huge.
And profit after tax, PDT, saw an even more astonishing increase, 144.2% year-over-year, reaching Rs 10.8 crore.
Wow, that pay-T jump is, over 140% year over year. That's fantastic. But, I can't ignore the other side of the coin here.
The sequential dip.
Exactly. While Q1 FY26 was strong compared to last year, Q1 FY25, there was that sequential dip in revenue, a 14.5% decrease from the previous quarter, Q4 FY25.
That's right, down from Rs 183.1 crore to the Rs 156.6 crore we just mentioned.
So, what do you make of that specific contrast? Is it just a short-term blip, maybe timing? Or does it signal something deeper, like a strategic pivot we should be aware of?
That's a really sharp observation. And yeah, that substantial growth in profitability, EBITDA, PBT, PAT, despite that sequential revenue dip is fascinating.
Right.
It strongly suggests MTAR isn't just selling more stuff, they're selling smarter. Maybe higher margin products are becoming a bigger slice of the pie.
Ah, so a shift in the mix?
Could be. Perhaps more from their defense or civil nuclear segments, which often carry better margins. Or it could point to, significant operational efficiencies they've found.
Improving the bottom line even if the top line fluctuates a bit.
Exactly. Getting more profit out of each rupee of revenue. It's often a hallmark of a company that's really optimizing its production and cost structure.
Okay, that makes sense. So what's actually driving these impressive profit numbers then? And what strategic moves is the company making to, keep that momentum going?
Right. Let's look under the hood. A big part of the story is their order book.
How's that looking?
It remains robust and, crucially, highly diversified. As of June 30th, 2025, it stood at 930.21 crore.
930 crore. That gives them pretty good visibility, I'd imagine.
Excellent visibility into future revenue streams. And it's not just the size, it's the quality and spread of those orders.
And they're clearly still pulling in new business.
Oh, yeah. They added another Rs 105.3 crore in new orders just in this first quarter, Q1 FY26, across various sectors.
So how does that Rs 930 crore break down? What's the mix like?
It shows a really healthy spread. Clean energy, that includes fuel cells, hydel, and others, that's the largest chunk at 47.6%.
Almost half.
Then you've got aerospace and defense, still very strong at 30.0%. Clean energy, specifically civil and nuclear power, is at 16.6%.
Okay.
And then products and others makes up the remaining 5.8%.
So pretty well spread out.
Absolutely. This diversified portfolio is a huge strength. It ensures they're not, overly reliant on any one single sector or customer type. It's like having multiple engines on a plane. If one sputters, the others keep you flying.
That's a smart way to manage risk. And speaking of new business, you mentioned new orders, but what about new customers? The presentation highlighted some additions over the last couple of years.
That's right. They've brought on board some major players, MNCs in aerospace, oil and gas, and various clean energy subsegments. Think battery storage systems, hydropower, wind energy.
And these aren't just one-off deals, presumably. Are they translating into actual work?
Exactly. These aren't just handshakes. These new relationships are translating into concrete production and, importantly, future revenue streams. They have several first articles under progress.
Okay, explain first articles for folks who might not know.
Sure. So a first article is basically the very first production unit a company builds exactly to a new customer's specifications. It gets rigorously inspected and tested by the customer.
Like a final exam before mass production?
Precisely. Once the first article is approved, the company gets the green light for full-scale or batch production. So seeing these in progress isn't just R&D, it's validating their manufacturing capabilities for new, often complex, critical products. It signals significant revenue potentially on the horizon.
Got it. So who are these for?
Okay, digging into the specifics. For Fluence, they've dispatched proto units. Those are initial prototypes for battery storage systems. And discussions are already underway for more.
Good sign.
With IAI, an aerospace and defense major, production of the first articles actually began back in FY25, and they've now locked that in with a long-term agreement.
Solidifying the relationship.
For Weatherford, in the oil and gas sector, execution of first articles is progressing, and again, another long-term agreement is signed.
Okay, O&G too.
They've even dispatched proto-valves to the Indian Navy and have qualified for volume production orders across various naval programs.
That's significant.
And importantly, batch production, so past the first article stage of new aerospace components, has commenced for huge names like GKN Aerospace, Rafael, Elbit, IAI again, and Thales.
Wow, that's a list.
It is. And the company states these are expected to be major drivers of aerospace revenue starting from this fiscal year, FY26. So that indicates a truly robust pipeline for future growth, especially in high-value areas.
That's a powerful pipeline indeed. Now, let's switch gears slightly. There was also a really interesting shift you flagged in their geographical revenue mix.
Ah, yes, the domestic versus export split.
Right. In the full year FY25, the revenue was, 64% domestic and 36% export.
Correct.
But in this latest quarter, Q1 FY26, that flipped quite significantly. It became 80% domestic and only 20% export.
Yeah, that's a noticeable swing.
What could be behind such a shift? Is it just timing of big domestic orders or something else?
It's an interesting point, and it does raise a question. It could certainly reflect a surge in domestic market demand, maybe timing of major Indian defense or civil nuclear projects kicking in.
Makes sense.
Alternatively, it might just be a temporary adjustment in export timelines. Global supply chain stuff, specific project schedules for overseas clients, things can shift quarter to quarter.
So something to watch.
Definitely. It's a dynamic we'll want to track in the coming quarters to see if it normalizes back towards the, say, 60-40 split, or if this 80-20 reflects a more sustained pivot towards domestic market.
All right, so beyond the big numbers and the strategic deals, how is the company managing its day-to-day operations, and what are the leaders saying about the future? Let's talk working capital, always critical for manufacturers.
Absolutely, a key metric. So net working capital days stood at 157 days in Q1 FY26. Now that's an increase from 139 days in the previous quarter, Q4 FY25.
Okay, 157 days. Remind us what that essentially means.
Think of it as how long it takes for the company to turn its investments in inventory and other current assets, minus what it owes suppliers, into actual cash from sales.
The cash conversion cycle, basically.
Exactly. To break that 157 days down, receivables money owed by customers were at 126 days. Inventory was quite high at 222 days.
222, wow.
Yeah, but importantly, that includes 110 days tied up specifically in work in progress, stuff being actively built, and payables money owed to suppliers were at 87 days.
So inventory seems like the big driver there. Is 157 days high?
Well, 157 working capital days, especially with that significant chunk in inventory and WIP, isn't necessarily unusual for a company like MTAR. They deal with long production cycles for complex, high-value components.
Right, these things take time to build.
Precisely. The increase from 139 days could reflect a strategic buildup of inventory for anticipated large orders coming down that pipeline we talked about.
Preparing for the H2 ramp-up, perhaps.
Could be. Or it's something to watch, as higher working capital days do tie up more operational cash. It's a key indicator of their operational liquidity and efficiency.
Gives us a much clearer picture, thanks. And what about the view from the top? Mr. Parvat Srinivas Reddy, the managing director and promoter, He offered some insights, right?
He did. He sounded quite confident in the commentary provided. He stated, and I'm quoting here, "We expect stronger execution in the second half of this fiscal year compared to the first."
Okay, directly addressing that sequential dip we saw.
Seems like it. He elaborated on their confidence in, quote, "sustaining export momentum despite tariff-related uncertainties," which is interesting given the Q1 mix shift.
Mm.
And he anticipates, quote, "increased order inflows over the coming quarters, supported by a robust demand pipeline in clean energy, civil nuclear, aerospace, and defense sectors."
So the pipeline remains strong.
That's the message. It's a clear signal that management foresees an acceleration in growth,
Mm.
particularly as that large order book translates into actual revenue in the latter half of the fiscal year.
Yep. Okay. Now, beyond the financials and operations, there were also some significant decisions made by the board of directors recently on August 5th, 2025. What did they approve that might impact the company's future structure or governance?
Right. The board had several important governance items on their agenda. Seems like ensuring stability and also setting up for the future.
Like what?
Well, they approved the reappointment of their current statutory auditors, Ms. S.R. Batleboy and Associates LLP, for a second 4-year term. That, of course, is pending shareholder approval.
Signals continuity and financial oversight.
Exactly. They also approved the reappointment of key directors. Mr. P. Srinivas Reddy continues as Managing Director, Mr. Akapati Praveen Kumar Reddy as Director and Whole-Time Director, and Mr. Anushman Reddy as Whole-Time Director.
All subject to shareholder approval too, I assume?
Correct. All subject to approval at the upcoming annual general meeting, the AGM.
Any other board decisions?
Yes, they also approved the continuation of Mr. Venkatazami Nana Sakaran as a non-executive and independent director. He's past the standard age, so this specifically allows him to continue beyond 75, again, subject to AGM approval. It highlights the value they place on his experience.
And when is that AGM?
It's scheduled for Thursday, September 18th, 2025. That's for the financial year 2024-25.
Yes. Anything else from the board?
And perhaps the most strategically interesting move. The board also approved a proposal to merge 2 of its wholly owned subsidiaries into the main company.
Oh, which ones?
GP Aerospace and Defense Private Limited and Magnetar Aerosystems Private Limited. They'd be merged into MTAR Technologies Ltd. itself.
What's the thinking there, usually?
Well, this isn't just bureaucratic housekeeping. Once it gets shareholder and regulatory approvals, it's likely a move towards streamlining operations.
Makes sense. Consolidation.
Exactly. Could lead to consolidated intellectual property, maybe reduced overheads, and just a more agile, unified company structure.
Easier to manage, potentially more competitive.
Precisely. Especially when bidding on larger integrated defense and aerospace projects. It looks like a calculated decision to simplify and strengthen their core operations.
Okay, lots of moving parts there. So let's try and tie this all together. What does this deep dive into MTAR Technologies mean for you, the listener?
Well, I think it really highlights how these companies, the ones specializing in niche, high-precision manufacturing, are just absolutely crucial for innovation.
The enablers.
Right, in sectors like clean energy, aerospace, defense. Understanding their performance gives us a glimpse into the underlying health and strategic direction of these critical industries.
And the story here isn't just about, one quarter's numbers. It's about a company showing remarkable profitability growth, even with that temporary revenue dip we discussed.
Driven by that robust, diversified order book, an exciting pipeline of new products, new customers.
And those strategic moves, like the potential merger to streamline things, it suggests a real focus on high-margin, high-impact components, the kind that are, literally building the future.
It does. Which leads to a final thought to consider.
Go it.
As global demands keep shifting, more sustainable energy, more advanced defense capabilities, next-gen space tech, how significant will the role of companies like MTAR actually become? These specialists in, as they call it, mission-critical precision-engineered systems.
Yeah, how critical are the critical component makers?
Exactly. And what long-term impact might their ongoing product development, their strategic partnerships, that structural streamlining we just talked about, what impact could all that have on the broader industrial landscape and just technological advancement in general over the next decade, especially as the world increasingly relies on these often unseen, hyper-precise foundations?
Something to definitely keep an eye on. A fascinating look behind the numbers.